Hey, it's Rachel, the CEO of Intrinio. We're a financial data company, and we're going to talk a lot about data in this video. Did you know that over 2.5 quintillion bytes worth of data are generated every single day? Today, we are surrounded and influenced by vast amounts of data. Personal, corporate, healthcare, environmental, stock, crypto, even interstellar data. As the data economy explodes around us, it gets harder to ignore the fact that every business and person is actually a data business. Identifying, harnessing, and putting your company's data to use is a challenge, but offers tremendous opportunity to those who rise to meet it. Companies operating in the financial industry, specifically capital markets, are a unique case. Many have made their money off of core services like banking, conducting research, or serving as a medium of exchange. However, the true power of these businesses lies not in their core services, but in the data and the exhaust that is created by them. Financial services institutions are unique in the volume and the value of the data they create. This makes a particular set of financial institutions poised to monetize their data and make it a core part of their operations. Those that prioritize and execute well may see data usurp their traditional lines of business. And here is why this matters. The global data and analytics market is worth $274 billion and forecasted to grow by another $100 billion by 2027. At a time when many traditional financial institutions' core business models are increasingly threatened by regulation, competition, fintech, and blockchain, pivoting towards a massive and rapidly scaling industry is enticing. In this video, I outline 5 traditional institutions that, whether or not they've realized it, are actually data companies at heart. First up, stock exchanges. NASDAQ, NYSE, CBOE, IEX, MEMX, and dozens of other exchanges in the US and around the world run massive and critical infrastructure and operations to ensure that trading and capital markets run smoothly. Most of the attention goes towards these exchanges listing businesses, working with up-and-coming companies to do a public offering and list their company on an exchange. But the actual listing process, however, pales in comparison to the data side of the stock exchange business. Every time a transaction happens on a stock exchange, a price for a security is created, and this exhaust transforms into powerful, mission-critical data sets used by investors globally. The bundling and distribution of these data sets can result in billions of dollars of revenue for these exchanges annually. Most of these exchanges are well aware that they are truly data companies and have started to act on it by creating sub-branded data platforms. NASDAQ acquired Quandl and launched Datalink. The London Stock Exchange acquired Refinitiv. IEX launched IEX Cloud. CBOE runs their own data shop. These new stock exchange data platforms are fairly nascent and lack the sophistication and modernity of traditional data platforms. More robust data strategies with special attention to innovating around the monetization and distribution can turn these traditional stock exchanges into modern data powerhouses. It can also help them diversify their revenue and avoid a complete meltdown as regulation creates more competition and blockchain starts to threaten their competitive positions. Number 2, sell-side banks. While investment research-oriented firms don't generate stock price data like the exchanges, they do create their own flavor of valuable exhaust. Across the US, tens of thousands of analysts crunch numbers into spreadsheets and make predictions about the stock market every single day. In many cases, this research floats around inside of these banks completely unmonetized. In other cases, rapidly scaling companies like Visible Alpha and Smart Karma have noted the value of this data and developed software solutions to more effectively collect and disseminate this data in collaboration with top banks and analysts. One of the most popular flavors of this exhaust is estimates data, but analyst research is a treasure trove of quantitative insights. These data sets and the demand for them highlights the growing power and value of the crowd, which is not always limited to the confines of major banks. For example, disruptive entrants like TipRanks sell blogger ratings and have conducted studies that show that these bloggers more successfully predict stock price movements than the traditionally trained analysts. In the future, expect to see rewards, incentives, and gamification enter the fold to incentivize the crowds and balloon the volume of insights generated from this exhaust. Banks and estimates-focused software companies have an opportunity to expand their identities past the generation and assimilation of just estimates data. They can leverage this expertise to think and behave more like holistic data platforms, taking their own swing at the billions of dollars waiting for them in the data and analytics market. Number 3. Database companies. Another class of unwitting data companies includes the firms focused more on the infrastructure supporting traditional data businesses. There's gas, but it's nothing without the pipes and the plumbing. Snowflake emerged on the scene as a powerful, exciting new tech company with a very successful IPO in 2020. And the market has since been abuzz with Snowflake's multi-cluster shared data architecture. Shortly after their public offering, Snowflake started to prioritize and promote their data marketplace, which now offers hundreds of data products. AWS, another critical database services provider to most financial services firms, has been heavily investing in building out their own data exchange over the past few years. Their platform now has over 6,000 data products, and Amazon is taking a major interest in financial-specific data. Both Snowflake and Amazon are banking on the fact that most data consumers also need to use database services. Providing data alongside those services can be a major value add in an industry where data providers are scattered and numerous. Being a go-to source of data may also help these companies increase adoption of their own core technology. It's a natural progression for database infrastructure companies to identify the data itself as a valuable product to capitalize on. Many important questions arise out of this analysis. Do the financial data companies need AWS and Snowflake more than these database companies need them? Is it reasonable to expect one or the other to replicate the other's business in a long enough time frame? What's easier, adding data sets as a product or building your own infrastructure? As the power dynamic between data and database companies unfolds, and as database companies recognize the power of the data flowing through their pipes, we may see consolidation or intense competition. Number 4. Crypto exchanges. The past few weeks have not been great for the crypto exchanges. Following FTX's massive insolvency and resulting bankruptcy, it feels like crypto is having its Lehman Brothers moment. Now, it is certainly true that blockchain and cryptocurrencies have taken their ride up and down the Gartner hype cycle curve, but while there will always be graves in the graveyard of emerging tech, I still believe heavily in the long-term applications and the staying power of crypto exchanges that choose to learn from these lessons, maintain transparency, and actually work with regulators. While the others are flocking away, I get interested. The remaining exchanges have the opportunity to do things differently and emerge as industry leaders. And just like the traditional exchanges we first covered in this video, these rapidly scaling crypto exchanges also generate a whopping volume of data. Of course, most of the attention is going towards their core exchange mechanics and not the billion-dollar ancillary business they could be expanding upon. The sheer number of coins on the market, coupled with the recent explosion of retail trading, has created a massive volume of trading activity in this space. Now, the jury is out on the viability, demand, and revenue potential from crypto pricing feeds, but that is not what gives crypto exchanges the potential to become wildly valuable data companies. These new exchanges have the luxury of building from scratch in a post-blockchain world. Traditional exchanges do not. This creates a massive competitive advantage and an ability to disintermediate the traditional securities space, from exchange to brokerage, clearing, custody, data, and more. Crypto and blockchain-based exchanges have the first mover advantage and a major technology edge through blockchain. In theory, their blockchain base takes care of exchange, brokerage, custody, clearing, even data. By thinking more holistically about themselves as data companies, crypto and blockchain companies can start to branch into other asset classes and start to disintermediate the multi-billion-dollar institutions currently running the show. FTX US, who is, as of now, unaffected by the collapse of FTX, recently made an investment into the traditional exchange, IEX, and has launched a new stocks-focused platform. This is a great first step in capitalizing on their advantage, but the longer-term value lies in data and their ability to develop a robust data strategy. The exchanges that start thinking of themselves as data companies and envisioning the possibilities will inflict formidable disruptive change upon the traditional investment process and the financial data industry. All right, lastly, mutual fund providers. Invesco, Fidelity, Vanguard, BlackRock, and dozens of others have built respectable and profitable businesses around the construction and sale of mutual fund and ETF products. These products create their own data exhaust, just like others on the list, in the form of net asset values, holdings, and more. Typically, These originators of the mutual fund products, and therefore the data, send all of the data to companies like Morningstar for free. Morningstar then aggregates the data and sells the bundled product right back to interested investors, including the original contributors of the data. The companies that send their data to aggregators like Morningstar for free have to buy the consolidated mutual fund data feed right back from them. Most of the companies we've covered today are creating data by means of exhaust and are at the very least making some money from it. Stock exchanges sell real-time pricing feeds. Investment banks collaborate with tech providers to distribute their estimates data. Database companies like Snowflake take a cut off of data sales from their data marketplaces. Crypto exchanges distribute publicly, at the very least, crypto pricing feeds, and they could charge for them if they wanted to. For mutual fund providers, however, data is an asset and an expense for them instead of an asset they are generating revenue from. There's no simple solution from switching the paradigm and turning that data from an expense to a revenue generator, but mutual fund providers have a significant opportunity to flip the script and become some of the most valuable data providers in the industry. Okay, we just covered 5 institutions that are actually data companies. Number 1, stock exchanges. Number 2, sell-side banks. Number 3, database companies. Number 4, crypto exchanges. Number 5, mutual fund providers. As the lines between who is an exchange, a bank, and an investment firm or a data company continue to blur, we will witness a profound transformation in the fintech space. This illustrates how valuable it is for all businesses, even outside of traditional financial services, to take an interest in data and find a way to include it in their business strategies. Now, we raised quite a few provocative questions today. Will traditional stock exchanges be able to pivot their strategies into data before regulation eats away at their core revenue? When will the power of the crowd and individual investor take over the sourcing of traditional estimates data? How will the power dynamic unfold between the snowflakes of the world and traditional data providers? How far into traditional securities trading will crypto exchanges branch? And how can mutual fund companies turn their data assets from an expense to a revenue generator? Only time will tell, but we would love to hear what you think. So please drop comments below so we can discuss. If this video was helpful, please give it a like and be sure to subscribe for more fintech and financial data content. Thanks for listening.